Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Sunlight Real Estate Investment Trust Annual Report. Sunlight Real Estate Investment Trust is a Hong Kong-based collective investment scheme that provides various businesses and services through its unit trust structure. The company's primary focus is on owning and investing in income-producing office and retail properties in Hong Kong. The group offers several key services, including property ownership and investment management. By listing on the main board of the Stock Exchange of Hong Kong Limited, Sunlight REIT provides a platform for unit holders to benefit from regular and stable cash distributions with potential long-term growth. Sunlight Real Estate Investment Trust maintains a market capitalization of $4 billion, broadly in line with the industry peer group. Sunlight Real Estate Investment Trust trades at an unknown price-to-earnings ratio of 14 times and a lower price-to-book ratio of 0.32 times relative within the industry. This suggests a potential market detachment, as Sunlight Real Estate Investment Trust trades at discounted levels, while the broader industry remains fairly valued, warranting deeper fundamental analysis. The balance sheet appears very conservative, with liabilities representing only 29% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The share count has increased while revenue and shareholder equity are declining. This indicates that management has not yet proven the business model is sustainable. This makes the investment case highly unfavorable. The company have a dividend yield of 7.83%. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be identified through a thorough analysis of various factors. On the positive side, revenue growth is primarily driven by car park income, occupancy rates in office and retail portfolios, the recovery of the Hong Kong economy, and softening funding costs. These factors contribute to an increase in revenue. On the other hand, revenue decline is largely attributed to several key factors. The lackluster commercial real estate sector has a significant impact on revenue, as does the decrease in fair value of investment properties. Additionally, negative rental reversion rates and decreases in rental income from operating leases also contribute to revenue decline. Furthermore, car park income and rental-related income have decreased, exacerbating the issue. The net income and profit margins of the company underwent significant changes between 2024 and 2025. In terms of net income, there was a substantial decrease of 32.3%, from HK $469,804,000 to HK $317,278,000. Furthermore, what was initially a loss of HK $173,015 in 2024 turned into an even greater loss of HK $175,445 in 2025. The profit margins also experienced a significant decline, dropping from 19.4% in 2024 to -4.8% in 2025. This drastic change indicates that the company's ability to generate profits has severely deteriorated. The implied EBITDA as a percentage of gross assets also decreased from 3% in 2024 to 2.96% in 2025, further highlighting the decline in profitability. The reasons behind these changes are not explicitly stated, but it is clear that the company's financial performance has taken a significant hit between 2024 and 2025. The decrease in net income and profit margins suggests that the company may be facing operational or market challenges that need to be addressed. The company's financial performance indicates a significant milestone. According to the provided summary, one of the key takeaways is that the company is successfully generating positive operating cash flow. This achievement suggests that the business is able to cover its operational expenses and generate excess funds. A closer examination of the company's financial statements, as mentioned on page 103 and page 134, would provide further insight into this accomplishment. However, based on the summary alone, it can be inferred that the company's cash flow management is effective, allowing it to maintain a positive operating cash flow. This is a crucial indicator of the company's financial health and stability. The company's performance across different segments has been mixed in the recent period. On a positive note, retail properties have shown significant growth, with revenue increasing by 33.8%, net property income growing by 34.6%, and segment results rising by 32.1%. This indicates that retail properties are performing well and contributing positively to the company's overall performance. On the other hand, office properties have struggled, with a decline in revenue of 37.3%, net property income falling by 36.6%, and segment results decreasing by 35.1%. This poor performance suggests that office properties are underperforming and may require attention from management to improve their financials. Management is optimistic about the company's outlook, citing sufficient financial resources to meet its needs by 2025. They attribute this confidence to a recovery in the retail market, driven by steady growth in visitor arrivals, an improved stock market, and lowered interest rates. However, management notes that not all areas of the retail sector will benefit equally, with prime street shops expected to remain resilient, while community shopping malls continue to face pressure. The company has made several strategic moves through acquisitions and divestitures. In terms of acquisitions, the company acquired certain companies from vendors on December 2, 2006. Additionally, it also received additional consideration for tax loss benefits utilized by the group. In contrast, the company has also engaged in divestitures to optimize its portfolio. One notable example is the disposal of debt securities during the year ended December 31, 2025. This move demonstrates the company's efforts to manage its assets and liabilities effectively. The company's financial records clearly indicate its commitment to rewarding shareholders through dividend payments. Specifically, for the fiscal years 2023/24 and 2025, the company allocated a substantial amount of $153,242,000 to $159,080,000 towards dividends. This significant investment in shareholder value is further reinforced by the confirmation on page 106 that the company has indeed paid dividends, solidifying its stance as a dividend-paying entity. That concludes the financial summary for Sunlight Real Estate Investment Trust. Feel free to comment below, and I will be happy to answer them when possible.